Okay, let's unpack this. When you think of an airport, what truly comes to mind? Is it maybe the hustle and bustle, the scent of duty free, or just that excitement of a new journey starting?
Mm.
Most of us see the planes, the terminals, the shops. Fair enough. But what if we told you that behind all that visible activity, an airport is actually a fiercely complex, surprisingly innovative business model?
That's right. It's really a miniature economy unto itself. And it's constantly grappling with massive global trends, very specific local regulations, and this incredible balancing act between public service and private ambition.
Indeed. We're not just talking about the functional mechanics here, are we? Runways and gates and that kind of thing.
No, not at all. We're diving deep into an entity that's simultaneously a critical piece of national infrastructure, a real commercial powerhouse generating significant revenue, and an ambitious international developer. It's a compelling blend, really. Faces unique challenges, offers fascinating insights.
Exactly. So today we're taking a deep dive into Flughafen Zurich AG FHZN for short. That's the company that operates Switzerland's largest international gateway, Zurich Airport. We've been meticulously poring over their latest investment analysis, comprehensive financial reports, a whole host of industry insights. And trust me, you are about to discover some truly fascinating dynamics that go, well, far beyond just air travel.
Yeah, our mission for you today is to give you a profound understanding of what makes this particular company tick. How does an airport successfully navigate, the complexities of a post-pandemic recovery, stick to incredibly strict local regulations, and push forward with massive international expansion projects, all at the same time?
It sounds like a juggling act.
It is. You'll walk away understanding why Zurich Airport is far more than just a place where planes land and take off, and what its unique approach means for its future, and perhaps even for how you think about critical infrastructure worldwide.
So what does this all mean for you? Whether you're a seasoned investor evaluating market opportunities, maybe a curious traveler wondering about the economics behind your journey, or just someone genuinely interested in how these complex global businesses operate, you're about to get a highly efficient shortcut, a way to be exceptionally well informed about a unique and strategically really important company. Let's dig in. Right, so our journey begins right there, at the heart of Switzerland, with the foundational structure of Flughafen Zurich AG. This isn't just any old airport operator. It's a truly distinct entity.
That's absolutely right. To properly understand FHDN, you first have to establish its core identity. This is the publicly traded owner and operator of Zurich Airport, ZRH, Switzerland's largest international gateway, and it's listed on the S6 Swiss exchange.
Okay.
So when you visualize Zurich Airport, you probably imagine this polished, efficient gateway, right? A perfect reflection of that famed Swiss precision and reliability.
Mm-hmm.
But beneath that sleek surface, there's a highly sophisticated business at play.
And what's truly fascinating, as you hinted, is its mixed economy structure. It's not a purely private corporation.
Not at all.
The Canton of Zurich is the largest shareholder, and they have a legal mandate to hold at least 1/3 of the company's shares.
Yes,
And then the city of Zurich holds another, 5.05%?
correct.
This isn't just a footnote, it's fundamental to how it operates.
It's absolutely crucial. This governmental anchor means FHZN isn't driven solely by quarterly profits, you see. This legal mandate and the canton's significant stake inherently influences long-term strategy, major investment decisions, even daily operations.
No, so.
Well, on one hand, it provides incredible stability. There's an implicit government backing that many private entities simply lack.
Right, a safety net of sorts.
Exactly. But on the other hand, it introduces a layer of political complexity. The canton, for instance, has the statutory right to appoint 3 of the 8 board members, and they can issue directives on highly sensitive issues, things like runway developments, aircraft noise regulations, big stuff.
Oh,
So it's a constant balancing act between commercial objectives and, well, the public interest, a dynamic tension that shapes its every move.
that dual responsibility makes it a pretty unique beast. And it's not just a commercial enterprise. The Swiss government has officially designated Zurich Airport as a key element of national infrastructure.
Yes.
It's mandated to serve as a vital European hub for global air transport.
And that designation is more than just symbolic. It really underlines the airport's systemic importance. Pre-pandemic studies painted a very clear picture of its economic muscle. The airport and its associated on-site companies were estimated to generate around CHF 7 billion in annual value.
7 billion, wow.
Yeah, contributing a substantial 4.4% to the Canton of Zurich's GDP and supporting over 27,000 jobs.
So when you're looking at FHZN, you're not just looking at an investment in an airport.
No, you're investing in a regional economic powerhouse.
Exactly.
This systemic importance, it solidifies its competitive position. It provides a degree of resilience even during economic downturns because its critical function ensures a level of support and necessity.
Speaking of critical functions, Zurich Airport also has this incredibly close, almost symbiotic relationship with Swiss International Airlines, Swiss, which, as you know, is part of the larger Lufthansa group.
Yes, and here's a crucial dynamic to grasp. Swiss and its affiliates account for a massive 52% of total passenger volumes.
Over half.
Over half. And a commanding 95% of all transfer passengers at Zurich.
95%, that's huge.
It is. This deep partnership creates tremendous efficiencies, making Zurich a highly optimized hub. However, it's also a double-edged sword. While it's highly efficient, it introduces a significant concentration risk. Meaning, if Swiss were ever to strategically de-emphasize Zurich, maybe in favor of other Lufthansa hubs like Frankfurt or Munich, the implications for FHZN's traffic development and overall profitability would be substantial. It's a critical relationship, one that needs constant monitoring. It's a partnership that defines much of the airport's daily rhythm.
Okay, so this unique foundational structure, these critical relationships at its home base, they set the stage for how Zurich Airport actually makes its money. And you mentioned this robust dual revenue framework.
Indeed. Flughafen Zurich AG operates what they call a resilient dual revenue framework. This is essentially a strategic balancing act between two distinct income streams. You've got regulated aeronautical income on one side, and more dynamic non-aeronautical commercial activities on the other. This diversification isn't just, a clever idea on paper. It has been a cornerstone of their financial performance. It's proved particularly crucial in navigating the turbulent waters of the post-pandemic recovery.
So let's break down the first part then. The aeronautical revenue. This is the core aviation business, the regulated side of things.
Precisely. This segment includes all the income directly tied to flight operations. So think of the flight operations charges passenger fees, landing fees, noise and emission charges, even parking fees for aircraft. It also covers other aviation fees for using essential infrastructure, things like the baggage system, de-icing facilities, check-in counters. As you'd expect, this revenue stream is directly linked to traffic volumes, so it was hit incredibly hard by the pandemic.
But the recovery has been pretty impressive from what the sources say.
Absolutely.
Yeah.
Strong rebound. In 2023, aviation revenues surged by nearly a quarter year over year. It recovered to 92% of its pre-pandemic 2019 levels.
Okay, almost back.
Almost back. And this momentum continued into the first half of 2024, bringing them to pretty much 100% of H1 2019 levels. But here's a fascinating, almost counterintuitive detail. It reveals how airports really tick sometimes.
Oh.
Even as passenger numbers were still recovering, Zurich's aviation revenue actually outpaced them in H1 2024.
How did they manage that?
Well, they strategically linked a critical system, upgrade a new baggage sorting system to slightly higher user fees.
Clever.
It's a subtle masterclass in optimizing income, even within a tightly regulated environment.
So even without a massive jump in passengers, they found a way to generate more revenue from this regulated side because of a system upgrade. That's a neat detail.
It is. It illustrates the ingenuity airports can show within regulations, and that regulatory environment is key. These charges are governed by the Swiss Federal Office of Civil Aviation, FOCOCA, based on EU principles. Now, while this provides a predictable, stable revenue stream for core infrastructure,
Maybe it's so good.
which is good, yes.
Yeah.
It also places a cap on the upside potential from this segment.
Right.
So while it offers stability, it's not where you'd expect explosive growth.
Okay.
That's where the non-aeronautical segment comes in.
The non-aeronautical revenue, the commercial side. This is where FHZN really shows its entrepreneurial spirit, isn't it?
Without a doubt. This is a highly diversified segment and, frankly, a critical driver of profitability.
Yeah.
It encompasses everything from retail outlets, food and beverage services, advertising.
That stuff you see when you walk around.
Exactly.
Yeah.
Plus parking facilities, real estate rentals, and utility allocations, various other services. And crucially, It also includes the revenue from the company's growing international airport business.
And this segment hasn't just recovered, it's actually outperformed its pre-pandemic levels. That's pretty remarkable.
It truly is. In 2023, non-aeronautical revenue climbed 18% to over 114% of 2019 levels.
Wow.
And this outperformance continued in the first half of 2024, reaching an impressive 117% of H1 2019 figures. The fact that this segment recovered faster and more robustly than its aeronautical counterpart is a critical feature of FHZN's business model.
So this is where they're proactively driving growth and really diversifying away from just passenger numbers.
Precisely. While aeronautical income is tied to passenger volumes, which are still, catching up, strategic initiatives in real estate, particularly the development of the Circle complex and their international expansion efforts, have created more durable, higher margin earnings base.
The Circle, tell me more about that. It's not just shops.
No, it's much more. The Circle isn't just a building. It's a strategic move to create a destination in itself, making the airport more than just a transit point. Think hotels, conference facilities, medical centers, high-end retail, all directly connected to the terminals.
Ah, okay. So it draws people in for reasons other than just catching a flight.
Exactly. This structural enhancement significantly reduces the company's pure-play exposure to the volatility of passenger traffic. It provides a much more stable foundation for future earnings and acts as a strong shield against external shocks, like, a pandemic.
That's a powerful combination. So with its home base strategically secured and diversified through this dual revenue framework, Flughafen Zürich AG isn't content to just operate in Switzerland. Here's where we see its global ambitions truly take flight.
This is where FHZN's long-term vision really becomes clear. International expansion, managed through its wholly owned subsidiary Zurich Airport International AG, is identified as a primary vector for future growth. It's a calculated move to diversify away from the mature and, let's face it, heavily regulated Swiss market. They're seeking opportunities where growth dynamics are superior.
And they've already got a footprint out there, haven't they?
Yes. Their existing international portfolio includes concessions and operational stakes in airports across Latin America, specifically in Brazil and Chile, and also in India. These provide a valuable base of diversified exposure, spreading their risk geographically.
But the real star of this international segment, the flagship project, seems to be the Noida International Airport in India. This sounds like a huge bet for them.
It absolutely is. Noida is a greenfield project.
Meaning from scratch.
Completely from scratch.
Yeah.
Built entirely from the ground up. Think of it as starting with a completely blank canvas, designing every aspect, rather than just upgrading an existing facility. It's designed to serve the rapidly expanding Delhi metropolitan area.
Okay.
Its significance cannot be overstated. This project makes FHZN the largest Swiss investor in India, and it provides them with direct exposure to one of the world's fastest-growing aviation markets.
Right. And the timeline.
The project is advancing rapidly towards a planned operational start in the fourth quarter of 2025.
That's ambitious for such a massive undertaking.
It is.
And while it offers incredible potential, it must also come with significant risks, I imagine.
You're right to highlight the risk. Noida represents a potentially transformational catalyst for the company's long-term growth profile, no doubt. But it is undeniably a high-risk, high-reward venture.
How so?
Well, think about it. While the Swiss operation is a stable, cash-generative asset, almost utility-like in characteristics, Noida is an ambitious foray into an emerging market. It requires substantial upfront capital expenditure. Estimates are between CHF 250 million and CHF 400 million annually in the coming years.
That's a lot of cash.
A lot. And with that scale comes significant execution challenges, regulatory hurdles, political risks, all inherent in such a complex, large-scale project in a developing economy.
So the success or potentially the delay of this single project could disproportionately impact the company's future valuation.
Precisely. This project is a huge bet. Its outcome will be a major determinant of FHZN's long-term trajectory. It tells you a lot about management's long-term vision and their willingness to take calculated risks for that potentially explosive growth.
It's quite a contrast.
It is. The challenge is balancing the rock-solid stability of their home market with the potentially volatile yet incredibly lucrative growth opportunities in an emerging market like India.
And what would success look like for Noida? Just opening on time?
Not just opening on time, though, that's key. It's also about hitting passenger targets and generating the projected cash flows afterwards. Immediate red flags to watch for. Any significant announcements of delays, budget overruns, or maybe changes in the regulatory landscape in India that could impact their concession agreement.
Okay, so understanding how Zurich operates at home and abroad with this ambitious plan, that sets the stage nicely for a broader look at its competitive landscape and the industry dynamics it navigates.
Absolutely. To truly grasp FHZN's position, we really need to understand the broader context. The European airport landscape has been undergoing significant shifts, especially in the wake of the pandemic.
And the overall news on recovery for Europe is positive, generally speaking.
Yes, generally. The European aviation market has largely bounced back. In the first half of 2025, total passenger traffic across European airports was up a healthy 4.5% compared to the same period in 2024.
Okay.
And, importantly, it stood over 5% above pre-pandemic H1 2019 levels.
Above pre-pandemic, that's strong.
It is. Though interestingly, this growth was driven entirely by international traffic. Domestic traffic has remained relatively flat.
So on the surface, things look good, but I'm sensing a but coming.
There is, and here's where it gets really interesting from a strategic point of view.
Hmm.
This recovery has actually exposed some significant structural shifts within the industry. A notable gap has emerged. You see a difference between the recovery of direct point-to-point connectivity that's still down about 5% versus 2019, and indirect hub connectivity, which is down a more significant 12% against 2019 levels.
12% down for hubs. That sounds like a big deal for traditional hub airports.
Yeah.
What's driving that change?
The primary driver, according to industry bodies like ACI Europe, is the aggressive expansion of low-cost carriers, the LCCs.
The EasyJets and Ryanairs of the world?
Exactly. These carriers now facilitate a staggering 47% of all intra-European direct connectivity.
Almost half.
Almost half. That's a substantial increase from just 39% before the pandemic. This aggressive growth has put immense pressure on the traditional hub-and-spoke models of legacy carriers.
Right.
Consequently, major Western European hubs like Frankfurt, Paris, Charles de Gaulle, they've seen their hub connectivity remain significantly below 2019 levels. Meanwhile, we've seen a shift, with Istanbul actually rising to become the world's top hub for connectivity.
So, if traditional hub-and-spoke models are struggling and LCCs are dominating point-to-point, why are airports like Frankfurt and Paris under such pressure? And what does this mean for a company like FHZN, which operates a hub? How does Zurich manage to thrive in this environment, seemingly going against the trend?
Those are critical questions. The pressure on traditional hubs comes because LCCs offer cheaper, direct flights, bypassing the need for a connecting hub for many, many travelers, especially within Europe.
Okay.
For Zurich, this sets a very challenging backdrop.
Yeah.
Their ability to succeed lies in a highly differentiated strategy. It's what we could call a boutique hub.
A boutique hub. Tell me more. What does that actually look like on the ground, and how does it protect them from these pressures?
Well, while many major European hubs are caught in this relentless race for sheer volume, battling the squeeze from low-cost carriers, Zurich has quietly perfected a totally different strategy. They're not competing on scale, they're competing on the quality of traveler they attract. Their secret isn't just having a wealthy catchment area, though that helps immensely. It's understanding that for a specific segment of travelers, value isn't about the cheapest ticket. It's about seamless efficiency, reliability, quality of service.
The experience itself.
Exactly. This makes them almost, you could argue, recession-proof in a way that volume-driven airports can only dream of.
That's fascinating. Okay, first, let's establish its dominance in its home market, Switzerland.
Absolutely. Zurich Airport is the undisputed leader in Switzerland. Handled a substantial 31.2 million passengers in 2024. To put that in perspective, its closest domestic competitors, Geneva and Basel, handled 17.8 million and 8.9 million respectively. Much smaller.
Right. So it has significant economies of scale within Switzerland, an unchallengeable position there.
Precisely. It's the big fish in a relatively small but highly affluent pond.
And that pond is crucial, you're saying?
It absolutely is. Zurich Airport serves a wealthy and economically robust catchment area, about 11 million people, and it extends beyond Switzerland into southern Germany and western Austria.
Okay.
This region is characterized by high purchasing power, a significant concentration of global financial institutions, pharmaceutical companies.
High-value industry.
Very high-value industries. This demographic creates strong, often inelastic demand for premium and business travel.
And I imagine that translates directly into higher revenue for the airport itself, not just the airlines.
It absolutely does. This premium demand results in higher yields for airlines operating out of Zurich, that's true. But crucially, it also translates into higher commercial spending per passenger at the airport. That non-aeronautical revenue we talked about.
Right.
Think of the business travelers needing quick, reliable connections, willing to pay for lounges or faster services, or high net worth individuals who simply don't compromise on service or quality, maybe doing more high-end shopping.
So it's not just how many people pass through, but who those people are. That's a key differentiator.
That demographic detail is really key to Zurich's success. It's a tangible competitive advantage that goes way beyond mere passenger numbers.
And you mentioned its hub function is resilient, unlike others in Europe.
Yes, remarkably so. In contrast to that broader European trend of weakening hub traffic we just discussed, Zurich's hub function has held up incredibly well. Its transfer passenger volumes have recovered robustly to 93% of 2019 levels. And interestingly, the share of transfer passengers has actually increased slightly to nearly 30%.
So more connecting passengers proportionally than before.
Slightly more, yes. This resilience, especially when you contrast it with larger European hubs that are still struggling to regain their transfer traffic, it really underscores the efficiency of the Swiss hub operation at Zurich. It suggests a highly optimized operation and a very strong synergistic airline partnership.
So they're not trying to compete on sheer scale with airports like Heathrow or Paris CDG. What's their core value proposition then, this boutique hub idea?
Their competitive moat is precisely that differentiated position, a high-quality, efficient boutique hub. They cater to a premium origin and destination, or O&D, market that is inherently less susceptible to the price-based disruption we see from LCCs. Their core strengths are built around superior service quality, punctuality, and privileged access to this high-value market. And this strategy is consistently validated by the numerous service quality awards the airport receives year after year. It's not just talk.
Right, they often win those awards.
They do. And that makes it incredibly difficult for competitors to replicate. For you as a traveler, it means a more reliable, pleasant, efficient experience. And for the company, it means real insulation from that cutthroat low-cost competition.
But even a successful boutique hub must face its own set of challenges and competitors. Let's look at what could disrupt this finely tuned operation.
No entity operates in a vacuum, of course. And FHZN certainly faces competition, both direct and indirect. When we look at regional airports like Geneva, GVA, and Euro Airport, Basel, Mulhouse, Freiburg, BSL, it's important to understand they serve distinct catchment areas.
Right, different parts of the country, different nearby regions.
Exactly. They also have a much higher penetration of low-cost carriers. For example, EasyJet commands a huge 46.4% market share at Geneva.
Wow, nearly half.
Yeah. So while they do compete for some leisure and point-to-point traffic, they don't really pose a direct threat to Zurich's core hub function, which focuses on those premium and transfer passengers.
Okay, so it clarifies Zurich's niche. They're not trying to be everything to everyone.
Precisely. They're focusing on their strength as a premium hub.
That makes sense. But Switzerland also has another formidable competitor that's not even an airport. It's highly efficient, high-speed rail network.
Absolutely. Switzerland's integrated rail system is truly world-class, and it serves as a formidable competitor for domestic journeys and even some short-haul international ones.
Right, like going to Milan or maybe Frankfurt.
Exactly. This places a potential cap on growth for air routes to cities like Geneva within Switzerland, or even those nearby international destinations where a train journey can often be more convenient, faster, city center to city center.
So how do they deal with that?
Well, FHZN actively mitigates this. They position Zurich Airport as an intermodal hub. They partner with the Swiss Federal Railways, SBB, on integrated products like Swiss Air Rail. This allows passengers to seamlessly combine air and rail travel on a single booking.
That's a very forward-thinking approach. Instead of fighting the competition, they're integrating with it. What's the potential future for hubs like that?
It's a textbook example of co-opetition, isn't it? They recognize the strength of the rail network, and rather than viewing it purely as a threat, they leverage it to enhance the overall travel experience, making Zurich Airport more accessible and appealing. The potential future for such intermodal hubs is immense, I think, especially as sustainability becomes a greater concern for travelers. They can offer a greener, more convenient option for shorter legs of international journeys, enhancing the airport's overall connectivity and reach without needing to add more short-haul flights.
Smart. But there's still that elephant in the room we keep circling back to. The significant dependence on a single airline group, the Lufthansa Group. This brings us back to airline industry consolidation effects.
Yes, and this raises that important question again. How diversified does an airport need to be in its airline partners? The Lufthansa Group, through Swiss, Edelweiss Air, and others, accounts for a staggering 67% of all passenger volumes at Zurich Airport.
2/3. That's a huge concentration risk.
It is. The health, the strategic direction, the network planning of this single group are paramount to FHZN's traffic development.
So any major decision by Lufthansa could create a massive headwind for Zurich.
Exactly. Any strategic decision by Lufthansa to, say, reallocate capacity or de-emphasize the Zurich hub in favor of its other hubs in Frankfurt, Munich, or Vienna, that would represent a major structural headwind for FHZN.
Is there anything they can do about that?
Well, there are long-term partnership agreements in place, and Zurich's inherent attractiveness as a profitable hub for Swiss, thanks to that premium catchment area, acts as a kind of natural safeguard.
Right, Swiss probably makes good money there.
Presumably. But this remains a crucial monitoring point. Early warning signs might include subtle shifts in capacity allocation data coming out of Lufthansa, or maybe public statements indicating a revised hub strategy. Zurich does have some leverage, given the efficiency and high-yield nature of its market, but it's a risk that simply can't be ignored.
Okay. Now that we've charted Zurich's position in the market, let's zoom back in on its financial recovery and those significant investments paving its way forward.
Right. The story of Flughafen Zurich AG's financial performance since the pandemic is one of a remarkably robust rebound. It's actually exceeded many initial expectations.
That's good news. Let's start with the top line. Overall revenue recovery. How's that looked?
After the severe downturn, the company's revenue has recovered with impressive strength. Following a significant rebound in 2022, total revenue in 2023 grew by a further 21%. And crucially, it surpassed its 2019 pre-pandemic levels for the first time.
Back in the black and then some.
Exactly. And this momentum continued right into the first half of 2024 and H1 2025. The company actually reported its best ever half-year result in those periods, hitting over CHF 640 million each time. This was clearly driven by continued passenger growth, yes, but also very strong commercial execution, particularly in that non-aeronautical segment we discussed.
That context about the pandemic hit is crucial, though, to fully appreciate this recovery. Just remind us how bad it got.
Oh, it was severe. The COVID-19 pandemic was undeniably the most significant disruption in the company's history. Passenger traffic at Zurich Airport plummeted from over 31 million in 2019 to just 8.3 million in 2020.
Wow, a collapse.
A collapse. This effectively halved total revenue and pushed the company into consolidated losses for 2 consecutive years.
So what did management do?
Their response was decisive. They suspended dividends immediately to preserve liquidity, they implemented aggressive cost reduction measures across the board, and they utilized government-supported short-time work programs to manage personnel expenses effectively. Those prudent, albeit difficult actions during the crisis really laid the groundwork for this rapid and, importantly, structural rebound.
So the recovery wasn't just fast, you're saying it was structurally improved somehow.
Absolutely. The pace and robustness of the recovery have been faster than initially anticipated by many observers. Passenger traffic reached over 90% of pre-pandemic levels in 2023 and had almost fully recovered by 2024, hitting 99% of 2019 volumes.
Okay.
But here's the critical point, the really fascinating bit. Profitability metrics like EBITDA actually recovered even faster than passenger numbers. They surpassed 2019 records back in 2023.
How is that possible? More profit on fewer passengers than before.
Exactly. It indicates they managed to become more profitable on slightly lower traffic volumes than before the pandemic, which suggests fundamental operational improvements or a more favorable revenue mix.
What about the traffic itself? What kind of travel came back first?
The recovery was initially led by strong leisure and VFR, that's a minor. Visiting friends and relatives demand, particularly for Southern European destinations.
Okay, sunseepers.
Pretty much. North American traffic has also fully restored, which is important. However, high-value traffic from the Far East, especially China, continues to lag behind 2019 levels.
Which could mean?
Which actually represents a potential future tailwind. As that high-spending traffic normalizes, it could provide an additional boost to both passenger numbers and, crucially, that high-margin commercial spend.
Right. So this wasn't just a simple bounce back. It was a structurally improved recovery, largely driven by a sharp focus on margin expansion.
Absolutely. One of the most impressive features of FHZN's recovery has been the significant expansion of its profitability margins. This wasn't a minor bump. It was a clear upward trend. The EBITDA margin improved from 54.3% in 2022.
Okay.
To a record 54.7% in 2023, and then further to a remarkable 56.0% in the first half of 2025.
And what's crucial there is that 56% figure is notably higher than the 53.0% margin they achieved back in 2019, before the pandemic hit. That speaks volumes about efficiency.
It truly does. This margin enhancement strongly suggests a structural improvement in the company's profitability profile. How do they achieve higher profits with slightly lower traffic? Well, it's a combination of factors. First, that revenue mix shift we talked about. It's become more profitable with their high-margin real estate and international revenues forming a larger portion of the total pie.
Okay.
Second, cost control. While operating expenses have naturally risen with inflation and increasing traffic, the pace of that increase has been demonstrably slower than their revenue growth. They've kept a tight lid on things.
So they're managing costs very tightly. What were the key cost drivers they had to manage?
Well, personnel expenses, obviously a major cost component for any service-oriented business like an airport, increased by double digits in both 2023 and H1 2025 as they staffed back up.
Right.
Energy costs have been a particularly dynamic variable. They rose sharply by 43% in 2023 due to global market volatility.
Ouch.
Big hit. But then, interestingly, they provided a welcome tailwind with a 13% decline in H1 2025 thanks to lower sourcing costs.
So that helped the margin in early 25.
It certainly did. The ability to generate higher profits on slightly lower traffic volumes is really a hallmark of a high-quality, efficient operator.
Yeah.
It tells you about their excellent cost management capabilities and their successful strategic pivot toward those higher-margin activities like real estate and international. The energy cost fluctuation is a perfect example of how dynamic external factors can significantly impact profitability, requiring really agile management.
Achieving higher margins is impressive, definitely. But it seems to be coming alongside some pretty significant spending as the company invests heavily in its future.
Precisely. You can't improve infrastructure and expand globally without spending money. In line with its ambitious growth strategy, Flughafen Zürich AG has significantly ramped up its capital expenditure, or CapEx, since the pandemic lows. Total investments rose from about CHF 235 million in 2022 to nearly CHF 440 million in 2023.
Okay, nearly doubled.
Nearly double year on year. And in the first half of 2025 alone, investments totaled a substantial CHF 422.9 million. They are not holding back.
So they're keeping up that high pace of investment. What's the outlook for the rest of 25?
The company anticipates spending approximately CHF 500 million in CapEx at the Zurich site for 2025. And another CHF 250 million for its international subsidiaries, primarily, as you guess, for the completion of Noida Airport in India.
Right.
These aren't just random expenditures. They are strategically focused on long-term value creation, modernizing essential infrastructure in Zurich, and pursuing those high-growth projects abroad.
This massive spending reflects a clear commitment to growth. How does this level of capital investment impact their current financials, though? And what are the long-term returns they are anticipating, particularly from a big bet like Noida? This is very much a forward-looking strategy.
It's absolutely a forward-looking bet. And yes, this level's investment does impact current financials by consuming cash flow, which we'll get to in a moment. But the anticipated long-term returns are substantial. For Zurich, it's about maintaining that premium, efficient hub status, justifying higher fees and commercial revenues. For Noida, it's about tapping into a rapidly expanding aviation market, potentially generating significant long-term cash flows in the future. Management is clearly confident, you have to assume, that these projects will deliver superior returns, justifying the current significant outlay.
Okay. Such significant investment naturally impacts cash flow, as you said. But Zurich Airport seems to be navigating this with a disciplined approach to its balance sheet.
Absolutely. Despite the heavy investment program, the company has maintained a remarkably disciplined approach to its balance sheet. Very prudent. For instance, they repaid a CHF 400 million debenture, a type of bond, back in April 2023. That contributed significantly to deleveraging or reducing their overall debt.
And their key leverage metric, that net debt to EBITDA ratio, looks pretty healthy.
It does. Very healthy. Excluding some specific noise-related provisions, this key metric improved markedly. It went from 2.32 times EBITDA at the end of 2022 down to a very comfortable 1.64 times at the end of 2023.
Okay, lower is better there.
Lower is better. It indicates a very robust and healthy financial position, giving them the flexibility they need for these ambitious projects without overstretching themselves.
But with all that CapEx spending, I imagine their free cash flow, the cash left over after investments, must be feeling the pinch.
That's correct. You've hit on the key trade-off. While their operating cash flow remains robust over CHF's 680 million generated in 2023, CHF 305.8 million in H1 2025.
Still strong cash coming in from operations.
Yes, but the heavy CapEx cycle we just discussed is currently consuming pretty much all of that cash flow, and then some. This has resulted in negative free cash flow for the first half of 2025 at minus CHF 117.1 million, even slightly negative in H1 2024 at minus CHF 1.5 million.
Now, if you're just looking at the headline numbers, you might see negative free cash flow and think, uh-oh, that's bad. But here, it sounds like it's actually a deliberate strategic choice.
Precisely. And that's crucial for you, the listener, to understand. Negative free cash flow isn't always a bad sign. In this case, it reflects a clear strategic trade-off. They are prioritizing investing heavily in these big future growth projects like Noida right now. Essentially, they're spending the cash they're earning today to build a potentially much larger revenue stream for tomorrow.
Like a farmer investing the harvest back into buying more land and seeds.
Exactly that analogy. Betting on a much bigger payoff next season. This implies a high degree of confidence from management in the projected returns from these future projects.
But what's the risk?
The implication, the risk, is that if those projects don't deliver as expected, if Noida faces major delays or underperforms, the company would face a tougher financial position. They might have to scale back on other plans, maybe take on more debt, or even cut dividends. It's a calculated risk, but one they seem to be taking from a position of current financial strength.
Okay, so these financial movements aren't random. They are very much part of a meticulously planned growth strategy and capital allocation blueprint.
Indeed. When we look at FHZN's growth strategy going forward, it's clear they're taking this dual approach, methodically enhancing their core operations at the Zurich site while simultaneously aggressively pursuing international expansion.
Let's start with the Zurich site development. It sounds like the philosophy there is more about enhancing quality and efficiency, not just cramming in more passengers.
Exactly right. The core philosophy at their home base in Zurich is firmly centered on elevating quality, ensuring safety, and improving operational efficiency, rather than purely expanding passenger capacity for its own sake. They're not just chasing numbers.
And how does that strategically impact the airport?
Well, the major ongoing and planned projects are strategically designed to deconstrain the airport during peak hours. This directly leads to improved punctuality, which is key for a hub. And crucially, it enhances the overall passenger experience, which in turn helps drive higher non-aeronautical revenue. It creates a kind of virtuous cycle. Better experience, more spending.
Makes sense. What are some of those key projects happening at Zurich right now or planned?
There are several significant ones. Long-term, they have the critical runway extensions. These are aimed primarily at enhancing safety and operational stability, not just capacity.
Okay.
Then there's the highly anticipated New Dock A. This is a major terminal replacement project, a huge undertaking, with construction slated to begin in 2030.
A long way off, but big.
Very big. In the more immediate future, there's that CHF 500 million investment to modernize the entire baggage sorting and handling system. That's scheduled for completion in 2025.
And that connects back to those higher user fees you mentioned earlier.
Precisely. That's the link. And finally, a multi-year landside redevelopment project is underway upgrading passenger areas, retail spaces, food and beverage offerings in the main terminal complex, keeping things fresh.
How do these seemingly incremental improvements, like a new baggage system or updated retail spaces, directly contribute to that boutique hub experience and ultimately the company's bottom line?
And what are the logistical challenges of doing all this while the airport is running full tilt?
Well, they might seem incremental, but their impact isn't. A new, efficient baggage system directly improves operational reliability, reduces wait times, cuts down on lost bags, all absolutely paramount for the boutique hub promise of smooth travel.
Right, reliability is key.
And updated retail spaces aren't just about aesthetics. They're carefully designed to boost that high-margin non-aeronautical spend per passenger. They do this by offering a more appealing, maybe more efficient, shopping and dining environment that caters to their specific passenger mix.
And the challenges of doing this while open. Oh, the logistical challenges are immense. Imagine renovating a large shopping mall or a major train station while it's still fully operational 24/7. You have to manage passenger flows, construction zones, noise, safety, all without disrupting operations too much. It requires meticulous planning, phased execution, constant communication. It really highlights the operational expertise FHZN has developed.
Okay, so while Zurich gets this quality upgrade, the real long-term growth engine seems to be firing up across continents.
That's right. While the home base is being refined and optimized, international expansion remains the primary engine identified for long-term growth. This strategy allows FHZN to deploy its proven operational expertise in markets that offer superior growth dynamics compared to the mature, heavily regulated Swiss market.
And we know Noida International Airport in India is central to this strategy.
Exactly. The entire international strategy is firmly anchored by this massive greenfield development. Expected to commence operations in late 2025, it provides FHZN with direct and significant exposure to India's rapidly expanding aviation sector, which offers a much higher growth ceiling than Europe.
And beyond India.
Beyond India, their existing portfolio in Latin America, recently bolstered by acquiring the Natal Airport concession in Brazil, provides crucial geographic diversification and access to recovering travel markets in that region, spreading the bet, so to speak.
What specific operational expertise does FHZN bring to these international projects? It's one thing to run an efficient airport in Switzerland, quite another in India or Brazil, right?
Yeah.
How do they adapt?
That's a great question. They bring a wealth of knowledge in efficient hub management, sophisticated passenger experience design, and advanced commercial operations, knowing how to maximize that non-aeronautical revenue. Their experience in a highly regulated, high-quality environment like Switzerland means they understand the importance of robust planning, safety protocols, sustainable operations.
So they try to replicate the Zurich model.
To an extent, yes. In emerging markets, they leverage this by focusing on building high-quality, efficient airports, often from the ground up, frequently in public-private partnership structures. The real challenge, of course, is adapting that expertise to very different regulatory frameworks, local cultural contexts, unfamiliar supply chains. That's where their experienced international development team and, crucially, strong local partnerships become absolutely vital mitigation factors for the inherent risks involved.
Okay. Investing so heavily in infrastructure and new markets, that means strategic decisions must also be made about how to reward shareholders, right? Balancing growth with returns.
This is a key balancing act for any management team in this position, and FHZN is clearly executing a dual strategy here. Aggressive reinvestment for future growth on one hand, while simultaneously restoring and consistently increasing returns to shareholders on the other.
And what's their stated dividend policy? How do they formalize that balance?
Their stated policy is reasonably clear. Pay out approximately 40% of adjusted net profit as an ordinary dividend. They also have the flexibility, written into their policy, to supplement this with additional dividends paid out from capital contribution reserves, which gives them a bit more wiggle room year to year.
How did the pandemic affect this dividend, and what's the recovery looked like since then?
Well, as you expect, during the depths of the pandemic, dividends were understandably suspended from 2019 through 2021 to preserve critical liquidity when revenues collapsed. Survival mode.
Right.
However, they were reinstated for the fiscal year 2022. Then, signaling strong confidence in their financial recovery and future outlook, the dividend was significantly increased for 2023 and then increased further for 2024.
Okay, a clear upward trend post-crisis.
Definitely. That gives them a current dividend yield of around 2.3% based on recent share prices.
What does this dividend history tell you about management's priorities and their confidence in these big strategic bets, like Noida? How do investors typically react to companies that manage this balance? It sounds like a tricky tightrope walk.
It is a tricky balancing act. This history reveals a management team that clearly prioritizes long-term sustainable growth, hence the initial suspension to protect the company. But they're also committed to rewarding shareholders once financial stability is reestablished and the outlook is clearer, hence the reinstatement and subsequent increases. That signals strong confidence in their ongoing cash flow generation and, implicitly, in the eventual success of their strategic initiatives, particularly Noida paying off down the line.
And investors like this balance.
Generally, yes. Investors typically favor companies that demonstrate this kind of balance. It suggests both a clear growth path and a commitment to shareholder value, not just reinvesting everything indefinitely. However, it also highlights that underlying risk we touched on. Should returns from major investments like Noida be significantly delayed or fall short of expectations, management could face a difficult choice. Do they reduce shareholder returns? Or do they increase leverage, take on more debt to maintain those payouts? It's a very delicate balancing act going forward.
Makes sense. Now, beyond the physical infrastructure and the financial models, Zurich Airport is also strategically investing in the, let's call it the invisible infrastructure, technology and digital transformation.
That's a crucial area for any modern airport aiming to stay competitive. And FHZN is actively investing in technology to drive improvements in two key areas: operational efficiency on the ground and passenger satisfaction throughout the journey.
What are some of these key initiatives they're working on?
Well, they've established the ZRH Innovation Hub, specifically to spearhead improvements to the customer experience and streamline internal processes. A dedicated unit for this.
Okay.
They're deploying various digital solutions, like smart cleaning systems, for instance, to optimize resource use and keep the terminals pristine, more efficient. And in a particularly forward-looking move, in partnership with the ground handler Swissport, Zurich Airport is actually a pilot site for autonomous ground support equipment.
Autonomous baggage carts and things like that.
Exactly. Autonomous baggage tractors, maybe loading equipment. This isn't just a flashy gadget. Imagine planes getting turned around faster, more predictably, with potentially fewer human errors, maybe reduced fuel consumption for ground vehicles, lower personnel costs in the long run.
That sounds potentially revolutionary for airport operations?
It could be. If successful and scalable, it could redefine efficiency in a way that truly impacts an airport's bottom line and potentially the passenger experience through better on-time performance.
So how might these technological innovations really redefine the airport experience or significantly reduce operating costs in the future?
These innovations could be truly transformative over time. Think about the airport experience for you. Potentially smoother, faster processes from check-in right through to baggage claim enabled by smarter systems, maybe biometric identification, better real-time information.
Less queuing, hopefully.
That's the goal. And on the operational side, autonomous ground equipment, if deployed at scale, could revolutionize aircraft turnaround times. That enhances safety by reducing certain types of human error on the apron. And it could drastically reduce personnel and fuel costs over the long term. This isn't just incremental tweaking. It's potentially a step change in efficiency. It leads to substantial long-term operating cost savings and a more predictable, resilient operation. It also positions Zurich as a leader in airport innovation.
Right. So we've covered the business model, the market position, the financial recovery, and the ambitious growth plans. But like any complex organization, Zurich Airport operates within a landscape filled with both significant opportunities and notable risks. Let's look at those next.
Absolutely. Understanding these risks is critical for you to get that full, balanced picture of Flughafen Zürich AG. They face a complex array of challenges, some unique to them, some industry-wide, that could impact both their operations and their financial performance.
Let's start with regulatory risk. You mentioned this earlier, and the sources flag it as having both high probability and potentially high impact. What are the specifics there?
It's a major one for Zurich. The airport operates under some of Europe's strictest nighttime flight restrictions and noise curfews already. Any further tightening, particularly during those crucial evening shoulder hours when long-haul flights often arrive or depart, could severely impair the airport's ability to function effectively as an international hub. It hits their core connectivity function. There's also continued uncertainty over the use of southern German airspace for approaches into Zurich, which could impose future capacity constraints if agreements change.
How do they fight that?
Well, they mitigate this risk through ongoing political engagement, lobbying efforts. They argue the runway extension project will improve operational stability and potentially reduce noise impacts in certain areas. And of course, airlines are investing in quieter aircraft technology, which helps over the long term.
It sounds like a constant battle.
It is. What's fascinating here is that constant tension between the public interest, the valid concerns about noise control from local residents, and the airport's essential economic function as a national hub. How much control does the airport truly have over these critical regulatory decisions? Ultimately, often not that much. They try to influence them through dialogue, demonstrating responsible management, investing in mitigation, but final decisions often lie with governmental bodies or even public referendums in Switzerland.
Then there's economic risk, always a factor.
Yes. As a major infrastructure asset fundamentally tied to travel and trade, FHZN is exposed to economic cycles. A severe economic recession in Europe or its key source markets would undoubtedly curtail both business and leisure travel demand. That's unavoidable.
But they have some buffers.
They do. The airport's high-yield, often less discretionary business travel component provides some resilience compared to purely leisure-focused airports. And those diversified non-aeronautical revenue streams the retail, the real estate act as significant buffers, providing some insulation. But even premium travel wouldn't be entirely immune in a deep, prolonged recession.
Geopolitical risk seems like a given for any global hub, especially these days.
Absolutely. It's a systemic risk. Escalation of global conflicts, political instability, even widespread health crises, as we saw, they can abruptly disrupt international travel patterns, sometimes overnight. FHZN mitigates this partly through the geographic diversification of its international portfolio, not having all its eggs in one basket. And again, relying on the relative stability and resilience of its core origin and destination market in Zurich itself. Diversification helps spread that risk.
And the industry-specific risk we talked about, a strategic shift or worse, financial distress at the Lufthansa Group or Swiss. You rated this low probability but very high impact.
Indeed, despite being considered low probability right now, the potential high impact makes this a crucial monitoring point for anyone analyzing the company. Remember, the Lufthansa Group accounts for 67%, two-thirds of all passenger volumes. Their fate is deeply intertwined with Zurich's.
What mitigation is there, realistically?
Well, there are those long-term partnership agreements we mentioned, and Zurich's inherent attractiveness as a consistently profitable hub for Swiss due to its premium catchment area acts as a strong commercial incentive for Lufthansa to maintain the status quo.
But what safeguards are truly in place in those long-term agreements?
These agreements usually involve commitments on minimum capacity levels or maintaining Zurich's designated hub status within the group's network. But push comes to shove, a major financial crisis for the airline group could potentially override even contractual obligations. It's a risk that remains.
There's also operational risk, especially with a massive, complex project like Noida.
Yes, and this raises that important question again. How do they manage these complex project risks in an unfamiliar regulatory and cultural environment? There's significant execution risk delays. Cost overruns are always possibilities with large infrastructure projects, especially greenfield ones in emerging markets.
How do they tackle that?
Mitigation includes deploying their experienced international development team, using a phased project development approach to manage complexity, and fostering those strong local partnerships we talked about. Key indicators to watch for project success or failure: any official announcements of construction delays, significant budget revisions, or any unexpected challenges in securing necessary permits or land acquisition in India would be red flags.
Okay. Finally, a financial risk that's flagged as high probability, medium impact. The strong Swiss franc. I actually remember trying to grab a coffee at Zurich Airport once, and my wallet definitely felt the pinch compared to other European airports. Is that a common experience that directly impacts their bottom line?
You hit the nail right on the head. That's a perfect relatable example. The persistent strength of the Swiss franc makes Switzerland, in general, a more expensive destination for international travelers using euros, dollars, or other currencies. And critically for FHZN, it reduces the purchasing power of those passengers when they're in the airport spending money in the shops or restaurants.
So it directly hits that non-aeronautical revenue.
Exactly. It has been observed to have a negative impact on commercial spend per passenger, which is crucial for their high-margin, non-aeronautical revenue stream. It might cap the growth potential of their retail and F&B businesses, particularly for non-Swiss travelers.
How do they mitigate that? Just accept it.
They try to mitigate it. They focus on premium retail offerings that might appeal more to less price-sensitive travelers. They actively try to attract high-spending passenger segments. And they also benefit from a natural hedge on the cost side, as a large portion of their operating costs are also denominated in Swiss francs. But it remains a subtle yet persistent headwind. It's a good example of how macroeconomic factors play out at a very micro-business level, directly impacting your travel experience if you're trying to buy a sandwich at the airport.
Right. But these risks are managed within an operation that has consistently proven its excellence and efficiency over the years.
That's a crucial point to balance the risks against. While the company doesn't explicitly report certain operational KPIs that analysts love, like cost per passenger, a thorough analysis of its available financial and traffic data clearly reveals a superior unit profitability compared to many of its European peers. This quantitative evidence strongly supports the qualitative assessment of a high-quality, highly efficient operation. They make more money per passenger.
And the airport has a shelf full of awards to back that up too, right?
It certainly does. Zurich Airport's consistent recognition through prestigious service quality awards, things like the Airport Service Quality ASQ Award from ACI, the World Travel Awards. These serve as key non-financial indicators of its operational excellence and strong competitive positioning.
How do those awards actually help, beyond bragging rights?
Well, these tangible awards translate directly into a competitive advantage. They enhance its reputation among airlines, making it a more attractive place to operate from, and among passengers, reinforcing that image of quality and reliability, making it a preferred hub for connections.
But even with all that excellence, they faced operational challenges, especially since traffic returned rapidly after the pandemic.
That's right. No operation is perfect, especially when pushed to its limits. Post-pandemic, the airport has experienced challenges related to congestion during peak periods. This has been evidenced by reports of longer queuing times at security or check-in and some missed punctuality targets for flights.
So parts of the system are strained.
It indicates that parts of the existing infrastructure are operating at or very near capacity during those peak times, underscoring the urgency and necessity of their ongoing investment plans. The significant long-term investment in infrastructure, those runway extensions, the new terminal facilities, is a direct, strategic response designed specifically to enhance operational stability and manage peak hour demand more effectively. It highlights a direct link between customer experience feedback and the company's major capital expenditure decisions.
And the airlines flying into Zurich, are they also running efficiently?
Yes, that's another positive indicator. Airlines operating at Zurich have achieved high levels of efficiency. The average seat load factor, basically how full the planes are, reached a record 80.4% in 2023.
That's high.
Very high. It indicates strong underlying demand for travel to from Zurich and an efficient utilization of available capacity by the airlines, which is a positive sign for both the airport and its airline partners.
Okay. This blend of financial strength, strategic growth, and proven operational excellence logically leads us to its market valuation. How does the market see this company?
Well, a comparative valuation analysis shows that Flughafen Zürich AG generally trades at a premium compared to several of its European airport peers.
Can you give us some context on that premium? For those of us who don't spend our weekends analyzing EBITDA multiples, what does trading at a premium actually mean here?
Certainly. For those familiar with investment metrics, FHZN's enterprise value to EBITDA, multiple duration measure, is approximately 12.7 times its earnings before interest, taxes, depreciation, and amortization. This represents a notable premium compared to, say, Aéroports de Paris, ADP, which runs the Paris airports, at around 10.4x, and Flughafen Wien, Vienna Airport, at about 10.2x.
So the market values Zurich more highly relative to its earnings.
Exactly. But what that essentially means for all of us, whether you're an investor or just a curious traveler, is the stock market seems to recognize something special here. Investors are willing to pay a higher price for Zurich shares relative to its current earnings compared to some other airport operators. They see unique qualities, stability, or growth potential worth paying up for.
Is Copenhagen's Lufthavn Copenhagen similar? Sometimes they show high multiples too.
Yes, Copenhagen does sometimes show higher multiples, but that often reflects specific market factors, maybe different reporting periods, or sometimes particularities in their capital structure that warrant a closer look before making a direct comparison. Zurich's premium seems more consistently justified by its fundamentals.
So this premium isn't just a random market anomaly. It appears to be justified by several concrete factors we've discussed.
Absolutely. The premium appears well-deserved based on the evidence. Firstly, as we've discussed repeatedly, FHZN demonstrates superior unit profitability. They simply generate significantly higher revenue and EBITDA per passenger than many of their peers. That's quality paying off.
Okay.
Secondly, its balance sheet strength is a major factor. With that low net debt to EBITDA ratio of just 1.64x, FHZN has a much stronger, less risky balance sheet than more highly leveraged peers like ADP. Less debt means more financial flexibility.
Yeah.
And thirdly, the valuation clearly incorporates, or prices in, that significant long-term growth option presented by the Noida Airport project in India. The market is giving them credit for that potential future growth from tapping into one of the world's fastest expanding aviation markets.
So the market seems to be fully reflecting the company's current strengths and future potential.
It seems so. The current valuation appears to reflect a full recovery of the core Swiss business back to its strong pre-pandemic fundamentals, plus a well-deserved premium for its quality characteristics, the stability, the efficiency, the premium market, and the exciting, albeit risky, growth potential embedded in its international portfolio, especially Noida.
What about its underlying asset base and the sustainability of its dividend given all this?
Good point. The company's total assets stood at CHF 5.1 billion at the end of 2023. Within that, property, plant, and equipment, the actual airport infrastructure was carried at a net book value of CHF 2.8 billion. But crucially, the replacement value of this critical long-lived infrastructure is substantially higher than its accounting book value. Building Zurich Airport from scratch today would cost vastly more. That highlights the inherent strategic value beyond just the accounting figures.
And its profile.
We need to reiterate its unique hybrid profile. It's not just a regulated utility. It has that stable, almost utility-like cash flow from the regulated aeronautical business. But layered on top are the commercial and international segments, offering higher growth potential but also carrying a higher risk. It's a blend.
Which brings us back to the dividend. Is it sustainable?
The current dividend yield of approximately 2.3% is supported by a payout ratio of around 53% of 2023 earnings. Based on current performance and outlook, that appears sustainable under normal operating conditions. However, it's really important for listeners to remember that future dividend growth is heavily contingent on the successful execution of its heavy capital expenditure program, especially Noida, and the cash flows those projects ultimately generate down the road.
So connecting this valuation discussion to the bigger picture, a premium valuation suggests the market sees something special. The key question then becomes, is the market accurately valuing the Noida project's potential and risk? Or is there still room for upside or downside surprise as that project unfolds?
That's precisely the key question for investors going forward. Is the optimism fully baked in or not?
Okay. Underpinning all of this, the strategy, the financials, the market position, is the quality of its leadership and its commitment to responsible governance, which nowadays must include sustainability.
Sustainability is no longer a nice-to-have. It's a strategic imperative, especially for an industry like aviation with a significant environmental footprint. Flughafen Zürich AG has made a strong public commitment to achieving net zero carbon emissions for its own operations by 2040.
That sounds ambitious for an airport. What does that actually entail financially? Sounds expensive.
It is expensive up front. It's going to necessitate significant ongoing capital investment. We're talking about spending on renewable energy solutions. They're looking at geothermal, expanding solar power installations, as well as extensive energy efficiency upgrades across their vast infrastructure, from terminals to lighting to vehicle fleets.
So more CapEx pressure.
Yes, it will undoubtedly exert further pressure on CapEx in the medium term, adding to the spending on Noida and Zurich upgrades. However, these investments are projected and expected to generate long-term operating cost savings through lower energy consumption. Think lower electricity bills, lower fuel costs. Furthermore, they will strategically mitigate the growing regulatory and financial risks associated with carbon pricing mechanisms, like emissions trading schemes. It positions the company more favorably for a future where carbon has a higher cost.
How do environmental goals really intertwine with financial performance for an airport then? Can sustainability actually be a competitive advantage, not just a regulatory burden or a cost center? This focus shows a long-term vision that considers more than just immediate profits, doesn't it?
It's an excellent question, and the perspective is shifting rapidly on this. Sustainability for an airport isn't just about PR or ticking boxes anymore. It's deeply intertwined with long-term financial performance and risk management. By investing now in decarbonization, FHZN is building resilience against future carbon taxes and increasingly stringent environmental regulations, which could otherwise become significant financial burdens down the line.
So it's risk mitigation.
Yes, but it can absolutely be a competitive advantage too. It can attract environmentally conscious airlines and corporate clients who track their own supply chain emissions. It improves community relations, which is vital given the noise and regulatory issues. It might even lead to lower borrowing costs for specific green projects through dedicated sustainable finance markets. So yes, it demonstrates a long-term vision that sees sustainability as an integral part of operational efficiency, risk management, and ultimately long-term value creation, not just an add-on cost.
So, after all that, what does this all mean? We've taken a really deep dive into Flughafen Zürich AG today. We've explored its unique mixed economy model, that dual revenue engine driving both stability and growth, and its ambitious strategic bets on international expansion, especially Noida.
We've seen a company that not only weathered a truly unprecedented global pandemic, but actually emerged demonstrably stronger in some ways, with improved profitability, a clearer strategic focus, and a detailed blueprint for its future. From the highly regulated, efficient skies of Switzerland to the rapidly growing, more dynamic markets of India and Latin America, it really is a testament to the power of strategic diversification and unwavering operational excellence in a very complex industry.
But it's also, let's be clear, a company that faces persistent and significant challenges, from those very specific local regulatory constraints like night curfews that directly limit its core hub operations, to the broader macroeconomic headwinds of a persistently strong Swiss franc impacting commercial spend. And, of course, the high-stakes gamble of a massive greenfield project like Noida International Airport, which carries both immense potential reward and significant execution risk.
Absolutely. So considering its compelling blend of critical national infrastructure at home and ambitious global growth abroad, it raises a fascinating question for the future. How might Flughafen Zurich AG redefine what it truly means to be a successful airport in the coming decades, especially as it continues that delicate balancing act between local regulatory constraints, global commercial opportunities, and those increasingly urgent environmental mandates? And perhaps more broadly, what lessons does its unique boutique hub and diversified approach offer for other critical infrastructure companies worldwide as they navigate similar pressures and opportunities in their own markets?
That's a profound thought to mull over as you next find yourself navigating the complex ecosystem of an airport wherever you might be. It's far more than just a place you pass through. It's a living, breathing business responding constantly to the world's changing dynamics and actively shaping the future of global connectivity. Until next time, keep digging deeper.